You need to leave it there for at least 5 years. That way we're investing and not gambling. And then the only reason we take the money out, which is the most important thing, the only reason we take the money out is because we found somewhere better to put the money. If I find somewhere that gets a higher return than my current investments, and I'm fairly confident that it's going to get me that return, I then sell some of my investments and I invest in that new opportunity. Whether that opportunity is in Hi, it's Dre Griggs of Obsidian Wisdom. Today we answer the question, what is the optimal order of investing for retirement? When it comes to retirement, there are so many choices of investments that you can take advantage of. And many of the times the answers that we're given there, they're kind of cookie cutter. Even I've looked at some of them and I don't think that that's really doing us a service. And so we're going to take a step back and let me give you my personal opinion, my personal thoughts on the optimal order of investing for retirement. The first place that I always invest, that's why the company is called Obsidian Wisdom. I believe you have to invest in yourself. You increase your value, you increase your results, and you increase your experience. You can't convince me that there's any investment better than investing in yourself. Whether that gets you a promotion, whether that increases your skill set to where you can start a business of some kind, whether it gives you the ability to protect your family, provide financial insight, and build a financial fortress around your family. The information that we are given is often not the best information. You guys know, and I encourage you all the time to read autobiographies, because you'll find that the way people actually created their wealth is slightly different than the way they actually tell us to create our wealth. And so we want to take a step back. So we'll talk about one example in particular. You will often hear people tell you the first place you want to start is with an emergency fund. I have told people the same thing as well. But when it really comes to my investment strategy, I believe that you have to choose investments in the way that your money is going to grow. We can look at an emergency fund as my liquid investments. These could be investments where I get a pretty good return, but I'm also able to access the money if there is an emergency. I'm not a big fan of the idea of just sitting our money in a bank account and getting 0.0001% because that's not keeping up with inflation. That's technically taking a 3% loss every single year. And if you've been dealing with inflation the past couple of years, you know that was more like 8 to 10%. So could you imagine having your investments having an 8 to 10% loss every year? Well, that's what happens with the emergency fund. Now, that doesn't mean I don't recommend it for some of my clients, because it really does depend on each unique individual situation. And sometimes that can be just our overall fear, where I'm not going to put you in an investment that I believe will accomplish your goal, but based on your overall risk tolerance, I don't believe it will work for you, because that happens with all of us. There are things that we can watch. And the way I would describe it is, let's say someone told me, hey, Dre, you can be a door-to-door salesperson. I can show you the door-to-door salesperson who makes $1,000 every single day knocking on doors. Are you interested? For me, even though you can make $1,000 a day doing it in this hypothetical example, if I know that I am unable to knock on 100 doors every single day, well, that means it's not going to work for me. So I often, whenever I see someone who's successful in accomplishing things, I ask myself, what is that person doing? Is it something I can do? And is it something I'm willing to do? Those are usually the three questions that I ask myself when I'm trying to figure out whether something might make sense. And I ask those questions as well, either directly to my clients, or I get that information just based on our conversations, because we all have different beliefs, and those beliefs are going to create the actions that we take, which is why it often makes sense to start by investing in ourselves, by exposing ourselves to some of these other alternatives, ways that we can invest our money that is slightly different than the way the system teaches us. Because if you keep in mind the goal of the system is to create lifelong employees, then that means everything it tells us is going to work towards that result. So once I invest in myself, build my own confidence, my own skill set, my own insight and wisdom, then I'm able to make better financial decisions that helps me to work my money in a better way. So I often tell people, let's start by investing in ourselves. Now, from there, it really depends on a couple things. It really depends on what return I believe my investment is going to get. If I believe that paying off my high interest debt makes the most sense, then I'm going to go pay off my debt, because I know that that is going to be a high interest rate. I would need to have a return that's higher than the amount of interest that I'm paying on my debt for it to make sense for me to allocate my money towards these investments. Now, with that said, I often encourage people that it's important to build certain habits that go with our new beliefs. The way the Bible describes it is, it will say that faith without works is dead, which is a very fancy way of saying that if you believe something, then you naturally would take action on that belief. If you don't believe something, then naturally you won't take action on that belief. So I can't believe someone who says that they have a certain belief, a certain faith, if I look at their actions and they're not taking actions on that. Most of us believe that jumping off a two-story building doesn't seem like a great decision. We all believe in gravity. As a result, none of us are jumping out of two-story buildings today. Our actions match our faith. Now, if someone told me, well, I totally believe it's a bad idea to jump out of a two-story building, and then they go and jump out of it, I'm going to say, well, they must not have actually believed that, which is why I often encourage people, if you believe that investing your money towards your financial freedom, towards your retirement fund is a great strategy, then I tell people, hey, let's just build the habit. Even if we only put $5 a month, $10 a month, $50 a month, whatever that number looks like, let's start aligning our beliefs with our new actions. I don't want us to say, I agree with everything you said. I have the transformation. It makes sense for me to invest. I understand that 65% of self-made billionaires have at least 3 streams of income. I understand that the top 10% of wealth in the United States owns 90% of the stock market. And then we go back to our regularly scheduled program. So even though it doesn't make pure financial sense for us to be allocating some money towards investments, even though we still have high interest debt, I do believe that it makes sense as far as changing your beliefs and your actions and your understanding of your relationship with money, that it makes sense for you to invest even a small amount of your money from every single check towards your financial freedom, towards your retirement. And then you can allocate the significant portion of it towards getting rid of your debt. I'm totally fine with that, especially high interest debt. But the thing we sometimes forget and overlook is when I'm in debt, I'm at a negative, right? I'm in the hole. And the way I sometimes will describe it to people is we got to put the shovel down. We got to stop digging a deeper hole for ourselves. So we put the shovel down, and then most people, the way society tells you is, okay, you got to get out of all of your debt. And I can appreciate that because it's going to help us allocate our money more effectively. But even when we get out of debt, we're just at zero, right? We're just back at zero. We're break even. We still don't have any money that's allocated towards our financial freedom. We still don't have any money that's being generated from our money so that we can stop trading our time for money, which is why for me, I do like the idea of even investing a small portion. And the third step of our optimal order of investing for retirement is going to split a little bit. And what I'm talking about is the taxes. There is different tax treatment for our investments. And I do believe that you want to allocate your investments in a way that makes sense from both a investment return perspective and your overall tax perspective. And so the way it will work is you have some investments that are considered pre-tax, which is just as it sounds. The money is invested before it is taxed. This could be your 401k, your IRA, a 403b. There's lots of accounts where the money is invested before it comes to you. And as a result, it is pre-tax. You normally take that off of your total income at the end of the year when you file your taxes. So you can get that tax break today, but you'll agree to pay the taxes in the future when you take the money out. On the other half, we have our after-tax investments, and that is just money that's already been taxed today. So you receive the money after it has been taxed. This money, now depending on how we allocate the money, this gives us the ability to actually lower some of our taxes in the future because we've already paid the taxes today. I'll put a link to another video where I'll share with you some investments that you can take advantage of to where you lower your taxes in your future for retirement. The way that you often make that decision is I'm going to focus on pre-tax if I'm someone who feels one of two things. One is I'm in a very low tax bracket now, and I believe I'll be in a low tax bracket in the future. Normally, if you're in a low tax bracket, most of the time, we're never talking about raising taxes on the lowest brackets. Now, it doesn't mean it doesn't ever happen. It just means we're normally only talking about raising taxes on the top 1, 5, 10%. And I think we would all probably agree with that. And so normally that means that I can put the money in the pre-tax. I can take the money in the after-tax. I'm probably going to pay a low tax return either way. Now, if you're somewhere in the middle where you're not quite at the highest highs, you're not quite at the lowest lows, then it probably makes sense for you to have maybe half of your money invested in pre-tax and half of your money invested in after tax. That's because we're not 100% sure what they'll decide with taxes in the future. So if you find that they lower taxes as we are now at kind of historical lows, well, then you can say, all right, I'm going to shift more of my money towards being taxed today. So that way, at least when I retire, I've already taken my tax hit. So I at least have the opportunity to keep these taxes low in my retirement. On the other end, if you're on the higher brackets, normally there's caps anyways, right? You can basically put like $20,000 inside of a 401k, basically put $6,000 inside of your IRA or your Roth. So it's sort of capped anyway. So you're probably going to pay in the higher tax bracket either way. But it doesn't mean that you should just give up on it. There are lots of different strategies that you can implement. But normally, as far as deciding which one I want to put more of my money in, it normally makes sense if you have things like an employer match where it makes sense for you to at least invest in that employer sponsored program up until the match. Now, when you take a step back and you actually look at the fees inside your 401k, it doesn't often make sense to have all of your money in your 401k because the fees are usually higher and you don't have as much ability to customize your investments. You really only have like three choices. That's all they're required to offer you by law: something that's aggressive, something that's moderate, and something that's safe. So if you want to have the ability to customize a little bit more and you want to be able to control the cost of your investments, then it only makes sense for us to have a good portion of our money outside of that 401k after we get to the match. Now, for those of you that it makes more sense to invest in the after-tax investments, there's really three categories that I focus on. And that is the stock market, that's the real estate market, and then that's business investments. These are ones where I can focus on growth and I can still have access to some relatively tax favorable strategies. We can take advantage of capital gains from our money in the stock market. We normally have pretty favorable tax treatments when it comes to the money that's inside of your business and how you allocate that, how you write off some of those expenses, how you can get different tax breaks and different incentives that even the state will offer you if you offer enough employment and things of that nature. So normally it makes sense from that perspective as well. And then when you look at investing in real estate, you also have some pretty nice opportunities as well as far as allocating your money. The thing I like about your after-tax investments the most is it's not putting behind this wall. So even though we have some nice pre-tax investments with our 401k and our IRA and different things, it's written into it that you can't touch it until 59 and a half. And while that may or may not be something that we often consider, like I was going to work anyways, it is something that we should be thinking about because our money is literally tied up in an investment. And if you put that money in your early 20s, you're talking about having your money tied up for 40 years with no promised returns, no guarantees, and they normally don't have as many investment options. And not to mention the fees are generally higher in a 401k. So if you think about it like that, that's just not normally an investment we would sign up for. If I came to you and I was running a hedge fund of some kind, and I said, hey, I want to tie your money up for 40 years, you can't touch it, and I get to keep it, and I'm going to take my fee out of it. And then you're saying, okay, well, what do I get in return? And I'll say, oh, well, I'm going to allocate your money in one of these three investments, and we can kind of talk about that. Maybe once a year, you can ask me a few questions, and we can kind of go from there on that. But if you're going to take this money out at any point in time before the next 40 years goes by, then I'm going to charge you a 10% penalty. You're going to be like, well, wait a minute. Man, I'm going to say the same thing. Well, it sounds pretty favorable for you, doesn't it? And I would agree. It sounds very favorable. That's why I'm often someone who encourages the stock market, because the stock market, you can have $1 and you can put it in the stock market. Now, I don't think you should, but you could. There's a very low barrier of entry to get into the stock market. And then as we mentioned, the top 10% of wealth owns 90% of the stock market. The bottom 50% of Americans owns less than 0.5%, which is just crazy. So I do like the idea of investing in the stock market because there's low barrier entry, and then you can get in the habit of having your money work for you to make more money. I do also like the ability to invest in real estate. Now, it depends on how much information and knowledge you have about real estate, but I do know people who love real estate where they have 12 properties and it funds their entire retirement, and they've been able to allocate that money in a way that's very effective. And they even got to a point where they have like a district manager, someone who manages the properties for them. And that can work for any of us. And I love businesses because my personal investment philosophy, when I choose investments and allocations, I try to find things that provide value for the most people. So there's things that could be healthcare. We know healthcare provides value for a lot of people. It could be service industry because again, you'll provide value for a lot of people. There's something about finding businesses operating the right way, focused on providing immense value for their customers that is a great investment. You will see investment fads come and go where companies are favored and companies are not favored. And I find that the most common and consistent businesses that we can invest in are the businesses that provide the most value to the most people. And when you look at the top 10 companies, they all check off that box. That is why I'm not sold on cryptocurrency, for example, because in my mind, I'm trying to think, how is that providing immense value for a large number of people on a regular basis? Sure, hypothetically, it could provide value at one day and one time, but currently I can't wrap my mind around it. And so for me, it doesn't mean I would never like cryptocurrency. It just means until I can wrap my mind around the value it provides people and how that's essential, that it's very difficult for me. For me, I would tell you to put the money in the stock market first, because as the lowest barrier of entry, you need to leave it there for at least 5 years. That way we're investing and not gambling. And then the only reason we take the money out, which is the most important thing, the only reason we take the money out is because we found somewhere better to put the money. If I find somewhere that gets a higher return than my current investments, and I'm fairly confident that it's going to get me that return, I then sell some of my investments and I invest in that new opportunity, whether that opportunity is in the real estate market or whether the opportunity is in a new business venture. Whichever one provides me a higher return than my stock market performance, that's where I sell my stocks and buy that investment. That's also when you sell your stocks inside of your portfolio. If I find a stock that is giving me a better performance in the future, and I believe that company fits within my overall investment strategy, then I will sell the stocks where either they've achieved the value that I believe that it was worth. So if there's not much growth left, right? I thought the stock was worth $100. I bought it at 75 and now it's at 99. Well, it's pretty much achieved what I thought it was worth. So there's not going to be much growth. That small distinction of when we sell our stocks is the difference between investing and gambling. So I have a number that I believe the stock is worth. I bought it based on that assumption, and then I see if my assumption is correct. As new information comes in, I update my assumptions, and then I see whether I should sell the stock. Now, granted, there are times that we're just wrong. And when that happens, we obviously cut our losses and sell the stock. We're not at the roulette table saying this next roll is going to be my magic roll. And if you follow this strategy, I believe that you will get the results that you want. This is my optimal order of investing. You may have a different one, but this is mine. I would invest in myself first. I would then decide to start investing in the stock market, and I would start investing and paying off my high interest debt. I would do them both together so that my beliefs match my actions. As we said, faith without works is dead. So I need them to be aligned. If I believe investing is necessary for me to retire successfully, I need to invest something, anything to match that belief, because I want to make sure that I'm telling myself, you not only believe this, you're taking action on that belief. From there, I then take my taxes into consideration. Do I think I'm going to be taxed more in the future, or do I think I'll be taxed more now? If they're going to be taxed more now, then I'm going to defer my money by putting it in pre-tax accounts. If I believe that I'm going to be taxed more in the future, I'm going to take as much of my income today and then invest it in after-tax accounts. Now, as our income increases, which is the whole point of a wealth and retirement system, then I know that I'm basically going to be maxing out whatever my pre-tax was anyways. And as a result, I'm then going to be investing in after-tax investments. And then I normally will do the stock market first, and then I will shift into real estate or business ventures. Depends on you personally, whatever you're most comfortable with. For me, I would do stock market first, business ventures second, and then I would do real estate third. That's for me personally. There are people out there who say do real estate first, and then you take that money to buy businesses, and then you take that money to put in the stock market, right? There, you can do the three in any order. So I'm not firm on that, but that's the order that I would go in. Lowest barrier of entry is how I chose the stock market. Also, I'm already technically buying these businesses because that's what the stock market is, right? I am buying businesses that I believe in. And so it's the same as business ventures if you really think about it. Not to mention you can invest in real estate investment trust, or what we call REITs, which is a very fancy way of saying that I'm investing in companies that are already buying real estate, flipping these properties, or they're taking the rental income every single month. Or sometimes you have mortgage-backed securities where the people are paying their mortgage bill every single month, and then you get that overall income. And the cool thing about REITs is they have to pass off 90% of the earnings to keep their favorable tax treatments. So normally if you find a really good REIT, it's a great strategy for you. From there, just do regular rebalancing, which is a very fancy way of saying whatever my overall investment strategy was, if something in the market changes that adjusts my overall portfolio, if I said I want to have half of my money in the stock market and half of my income coming from real estate, and for some reason the real estate market is going boom, so now like 70% of my money's coming from real estate, then I should make some sort of an adjustment in my portfolio to bring me back into favor. We don't want to be too overexposed to any market. And one of the beautiful things about having this rebalancing strategy is it takes the emotions out of investing. And all that means is it requires me to sell when the market is high. As we mentioned, if I have a portfolio that was supposed to be 50-50 in two assets, and one of them is at 70%, the other is at 30%, that means one of them is performing kind of poorly, and that means the other one is performing really well. The average mindset will say, okay, if my 30% part of my asset class is suffering, then how about I sell all of that and buy all of the one that's overperforming? But the reality is that would be you buying high. You literally sold low and bought high. Does that sound like a winnable strategy? Does that sound like that's going to work? And the answer is no, that's not going to work. If we're constantly selling low and buying high, we're going to run out of money. But when you have the rebalancing, what it does is it requires you to sell the highest asset, the one that's outperforming the market. We're going to sell that 20% to bring it back down to the 50%. And then what do you do with that 20% profits? You go to buy the other asset class that's underperforming right now to bring the 30% back up to the 50. So now you have a portfolio rebalanced and you actually sold high and bought low. which is what we all want to do when it comes to our overall investment strategy. But you can see why it's very hard, why most people are unable to do that, because it requires you to sell when the market is going really well. And it requires you to buy when a certain asset class is not doing really well, which gives most people heartburn when you really think about it. But if you have a system in place, you're taking the emotions out of it. The only thing I'm thinking about when an asset class is underperforming is, why is it underperforming? And is that a long-term impact? If it hasn't significantly altered my overall investment approach, then I maintain the strategy and will keep going. If something significant happened, let's say there was a new law that changed the whole dynamics, or there was a war that started, or the CEO had to step down, or there was a new technology that came out that was going to erode what I thought was a pretty strong market, then that is a significant change and I should reapproach my investment strategy. But if it's just the ebbs and flows of business, and maybe they got a bad rating, or something that's not going to change the overall approach of the company, then I should be very comfortable buying that stock on sale, buying a business on sale. If I walked up to you right now and said, hey, look, I have a Lamborghini and it's $10,000 and I can show you that there's nothing wrong with it, everything's great about it, you should be willing to do anything you can to get it, because you know, at a minimum, even if you don't drive the Lamborghini, that you're going to be able to sell it for significantly more than what you bought it for, which makes it a solid investment. And as long as you have an actual investment strategy, you can have that same comfort where it's okay that the price is lower, because I know that this is a great investment for me. With that said, I'm always thankful for the time that we spend together. Thank you for watching this video. If you found value, go ahead and like and subscribe so you can continue receiving valuable insights on how to create your own wealth and retirement system so that you can worry less and live more. Until next time, stay safe and enjoy life.